stock markets forgetting what they told us just last week, or are they just sleepy after all of their exertions recently? That's the question that we're going to ask ourselves here on Macro Money. Welcome. I'm Ilya Spivak, head of global macro here at tastylive. We return, having been off air yesterday because of a power outage here in San Francisco, California. But the atmospheric river has passed us by, it seems like, traveled south. Good luck to them with that. I know it's certainly a very challenging situation, but we press on to ask, how is it that stock markets put such an emphatic exclamation point on the bullish argument on Friday, seemingly against every shred of evidence leading up to that announcement, and then didn't follow through? And so the question that we're going to ask ourselves today is simply, what are they afraid of? If anything, of course. What is it that is on investors' minds that after a blistering jobs report on Friday, that against all odds, seemingly, investors actually liked, why is it that we can't make further progress on a week when seemingly there's nothing standing in the market's way? Let's first get a bit of a sense of what the variables are that we're talking about here, and then let's consider why it is that things might be behaving as they are. So, first and foremost, of course, a bit of stage setting. Here was the jobs report as it came out on Friday. We can see here clearly there has been a significant deviation here from baseline forecasts. 353,000 jobs added. That's against expectations of 185,000. So almost double the expected number of added jobs. The unemployment rate, steady at 3.7%, right in the middle of the range that it's occupied now basically for 2 years, between about 3.4 and 4%, against expectations that there would be a rise toward the top of that range at 3.8. So again, better than expected. On top of all of that, and we don't have that on the chart here, wage inflation quickened. Average hourly earnings up 4.5% year on year against expectations of 4%. So there's all kinds of strength, seemingly, in this data. And not surprisingly, it follows something of a pattern. In fact, as we were looking at this ahead of the jobs data last week on Thursday, something that we pointed out, and something that's surely unmistakable for most markets participants by that point, is that there's a bit of a theme that's going on here. U.S. economic data, key release after key release, is showing up better, stronger than expected. The GDP number, of course, was one of the more emphatic versions of this over the past 2 weeks. 3.3% annualized quarterly growth in the fourth quarter. That's against expectations of just 2%. Just ahead of that number, the PMI data that we saw for January. Again, much better than expected. A return to growth for manufacturing, whereas continued contraction was expected. As ever, this is operating on the logic of PMIs. So 50 is the center line. Above 50 is growth. Below 50 is contraction. The faster you go above 50, or the further you go above 50 rather, the faster that expansion. The further you go below, the faster the contraction. So looking at manufacturing here, for example, 50.3 is a modest expansion against expectations of 47.2, which is a significantly speedy contraction. The service sector, the largest part of the economy, almost 53 against expectations of 51. That gave us a composite index taking in both manufacturing and services at 52.3 versus 50.3. So signs of strength all around. Now, what this has produced is a very interesting reaction from both stocks and credit markets. Not surprisingly, the strength in the economic data has eaten into Fed rate cut expectations. And so we see those in the gray bars here. And we can see that whereas at the start of January, we were looking at perhaps as many as 6 rate cuts, looking at something in between 150 and 175 basis points. Now we're looking at something closer to 1% or 100 basis points. So we've shaved almost 50 basis points, 44 to be precise, out of the rate cut outlook. We also see that the way that stocks have performed in that environment has been a clear disconnect from the way that this rally in the bellwether S&P 500 here is a kind of catch-all for U.S. equities, the way that that rally was built. Notice that from mid-year, what we have is a reduction in rate cut odds that, with a bit of a lag, about a 2-week lag here, gives us a decline in stocks, and then an expansion of rate cut odds, again with about a 2-week lag from here to here, right there, that gives us a blistering stocks rally. And of course, now we are again looking at moving in this direction. We've seen this before, but stocks are going higher. Now, the question seemingly is, are we looking at a repeat, or is this in fact well-founded? And of course, the version of this story as well-founded is a very encouraging one, because essentially what it would say here is that we have an increase in policy expectations. In other words, we're expecting higher rates, that is, fewer cuts to those rates, for good reasons. Economic data is strengthening. The economy is better than expected. It doesn't need as many cuts. Surely this is good news for earnings, good news for companies that are inherently tied to those earnings in their valuation over a reasonable time horizon. And so surely this is a positive story. One might argue the market is saying to us, well, good, the economy is better, we need fewer cuts. That's not the Fed being stingy with cuts when the economy is suffering. This is a good story. Stocks should be going up because the business cycle itself is turning up, and stocks are a pro-cyclical kind of asset class, ultimately. And then one looks at the price action and starts to wonder. Let's zoom in on the S&P here one more time and actually look at the way that it has moved. So last week, of course, the big move lower is the FOMC policy announcement, where the Fed turns out to be more hawkish than the markets are anticipating. They're looking for the Fed to endorse a rate cut relatively soon. The Fed instead comes out and says, actually, we're not nearly as eager to cut. And by the way, a move in March, according to Jay Powell, is unlikely. That, of course, is something the markets end up disliking, much like the build-up into the rally as we just saw it here in the fourth quarter, especially. Fewer cuts give us stocks lower, more cuts give us stocks higher. When we look at this, then, this would be one of those instances where we get fewer cuts in the outlook and stocks decline. So it feels reasonably textbook. And then, of course, there's the jobs data. We just saw it was emphatically better than expected. And the markets essentially reset ahead of that data. They rally as if to say, okay, well, the Fed said what they said, but let's see some actual data to see if they can back it up. Then the data comes out. And initially, the markets don't like it. For about an hour, the S&P is underwater. And then not only does it recover, it pushes to a new record high and issues a new record strong close. So all signs seemingly are saying, yes, the markets are happy here with fewer rate cuts in the outlook because, look, this is the economy being strong. This is not bad news. And then this week, nothing. Take a look at the bars that we have here for the first 2 days of this week, and you find that we are well within Friday's range. And that's without a major macro catalyst sitting on the calendar, menacing investors, saying, don't have directional conviction. There's still this event risk. That's not the story of this week. The macro calendar is all but empty when it comes to really heavy duty, really top tier kind of risk. To get that, you'd have to go to next week. Even the earnings calendar this week, amid the ongoing reporting season, even that's relatively quiet, especially for the big names that have been the source of strength in this market, mainly in the tech space. So the markets seemingly have no speed bumps that are immediately in their way, and yet they don't want to go. They do not want to build on these gains. They don't want to find in Friday's signaling a reason to keep momentum strong. Now, does that mean anything? Maybe, maybe not. It could be that we are simply taking some time to digest having hit record levels. Possible. Wouldn't be the first time, certainly. And the absence of another catalyst might well give the markets a bit of an opportunity to take a breath. Or one might think, well, if we've rallied with such emphasis and there is no reason not to, whereas there seem to be all the reasons to keep going if, in fact, the pro-cyclical good news is good, fewer rate cuts for economic strength reasons is a risk-on proposition for all of those reasons. If that were true, why aren't they going higher? And something begins to echo. Because indeed, the circumstances we find ourselves in now look worryingly similar to the circumstances we found ourselves in almost exactly 1 year ago. And of course, that episode did not end so cleanly. Recall that when we were looking at markets at the beginning of last year, as we do now, we were looking at a rapid strengthening of U.S. economic performance. Here's the beginning of 2023. We seem to set something of a bottom on the way that data is performing relative to forecasts right around mid-month in January. And then we can see there is an emphatic push higher. Data is strongly outperforming relative to forecasts. And by the way, this jump right here is another similarly dramatic beat on NFP as we've just seen. Now, of course, we know what this ends in. Let's take a look back at at this chart through just the first half of last year. Here is where that data bottoms. And what we find is that as we go here, we are shaving rate cuts out of the outlook. Of course, this is still the 2024 outlook, so these moves are going to look a bit shallower. If one were to look at the 2023 outlook at the time, for which the pricing is at this point somewhat irrelevant, we would find a more dramatic incline. But what we find is that with this improvement in economic data, from the 18th of January onward, we get fewer rate cuts, so we get a hawkish shift in the outlook, and for a while, stocks go up. Right until the beginning of February. So there's about 2 weeks in here. Now, we can see it begins right there. What we find now looks like an even steeper initial push higher in U.S. economic data. And as we just saw, once again, the initial response from markets is that they seem to be okay with this. Now, of course, the pushback in rates here is a little bit more steep, but of course, at the time, if we were looking at 2023 expectations, it too would be steep. And so we have to take that with a grain of salt, not necessarily interpolate the current environment to be more of a dramatic adjustment than at the time. But direction-wise, the parallels are quite clear. Better data, stronger economic performance leads to fewer cuts in the outlook, and stocks hold up until they don't. Because, of course, what happens immediately thereafter is the SVB-led banking crisis. What we see occurring right here then begins to squeeze stocks lower as rates are adjusted. And then, of course, right around here, something snaps. And rates end up pushing into an area that's stressful enough that people begin to worry about refinancing of debt, about the capabilities of regional banks linked to tech in particular at the time to withstand those higher rates. There is a bank run and a crisis. Now, importantly, the move in stocks lower doesn't need the crisis. The crisis is the aftermath. This adjustment in the S&P begins earlier and ultimately is validated because there is a squeeze. But the markets begin to get leery early and say, hey, oh, hold on a minute now. This rise in rates might well put stress on something. Let's begin looking for possible areas where that vulnerability could exist. And invariably, they find it. The situation we find ourselves in currently is not so dissimilar at all, wherein we have a run-up in U.S. economic data. That run-up begins to squeeze rates. And then those rates begin to raise questions about who can't stomach this level of borrowing costs. Because indeed, if we look back once again to where we find ourselves currently, we find that we are at this point looking at the most modest outlook for Fed policy easing since essentially back here, relatively early in this run-up, or at least let's call it about halfway into it. And yet there's been no correction so far. Is it possible then that what the markets are saying here is, well, look, we've seen this movie before. We know what happens when there is a rapid repricing toward higher rates in this environment. Something invariably starts to wobble in the credit space. Or at the very least, investors become worried that something might wobble and begin looking for reasons to de-risk. Now, as of course we've said before, the pile in which one might look for issues is a staggeringly large one. It does, of course, help when we look at the debt to GDP ratio side of this, that it seems the economy is growing faster, and so the GDP component seems to be expanding quicker, so debt as a percentage of GDP may well have a bit of room to come down just because the numerator is relatively steady, but the denominator is perhaps growing faster than expected. But nevertheless, this is a staggering amount of debt, both public and private. And with an average maturity of maybe 4 to 5 years across all of it, there is a tremendous pile here that is financed at very, very low interest rates relative to what's available in the market now. Furthermore, according to S&P Global, about 30% of this pile has a floating rate, which means that even if there isn't a redemption, even if there isn't refinancing risk, managing that debt with interest rates effectively 4 or 5 times higher now than when the debt was incurred is going to require much more cost to service. So, while certainly not all of this pile is due to mature this year, the vastness of it means that if rates are squeezed, then perhaps we do find a pocket in here that can't stomach it just because there are so many pockets to choose from. And so perhaps what the markets are worried about here is that this adjustment in rates will invariably find that pocket. And whether it's found or not, de-risking may begin, just as we saw last go-round, where stocks started to wobble relatively early before there was an SVB crisis. And only weeks later did we actually get the pressure almost in a self-fulfilling way, where the markets got leery, they started to de-risk, and then the process of de-risking sparked a panic. It may very well be that the markets are reluctant to build on Friday's gains because this is precisely what they fear might happen. And if that fear self-actualizes, well, then we might have a self-fulfilling sort of situation on our hands. As it happens, history would suggest, and granted, there's not a statistically significant number of occurrences here just because there's only been so many rate hike cycles since the onset of the current financial world order, really in the aftermath of Volcker's disinflation, Paul Volcker's aggressive effort to beat inflation back in the late 80s, as well as the decoupling of the US dollar from gold that led up into that in the 70s. There's only so many rate hike cycles in that subsequent period that we find ourselves in now. But it seems that every single time we've had a meaningful rate hike cycle, about 24 months thereafter, on average, we have had a spike in the VIX, implying that there's been some sort of market stress that has followed about 2 years after the start of a meaningful Fed rate hike cycle, which of course would put us right in the window now, because this rate hike cycle began in March of 2022. And we're approaching its 2-year anniversary. So maybe the markets are just digesting. Or maybe they're beginning to sniff the kind of risk out there that they've seen before, and perhaps the very fact that they're concerned about it, if that is indeed what this standstill is all about, is a self-actualizing liquidation phase. It's certainly not here today, but it's certainly something that I'm looking out for as a landmine, perhaps over the coming weeks and months. And that is my macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the close on Wall Street and what may happen next. I'm back on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. See you tomorrow.